Good morning, everybody. We'll be starting in about 30 seconds. Good to see lots of people have joined us already. We'll just wait for the last couple of people to come through. Okay, let's go. Good morning, everybody, and thank you for joining us today for Sullivan Dewing's 2026 Federal Budget Q&A. I'm Jeni Wilcock, Director at Sullivan Dewing, and joining me today is my fellow Director, Heather Locker. Together, we'll briefly walk you through the key announcements from this year's federal budget. I'm sure you've seen a lot of it. It's been in the press prolifically. And most importantly, we'll walk you through what the changes mean for property investors, for trusts, and for business owners.
Thank you, Jeni. Welcome, everyone. There's been outrage as well as wide and valued discussion around negative gearing, capital gains tax and taxation of trusts. And today we will answer the many questions we have received. So please also add any other questions you have in the Q&A section, and we will get to them at the end of our webinar. The bill that includes the negative gearing and CGT changes will be introduced into Parliament tomorrow, with the government expecting them to get through unchallenged by July 2. Any carve-outs would be later legislated in a second tranche of bills after the original bill has been passed. The bills containing the trust changes will be introduced later in the year.
Jim Chalmers says, these tax changes will help about 75,000 Australians achieve the dream of home ownership. And this budget is taking a reform path to make the tax system fairer for young Australians. Angus Taylor says, the changes are a war on ambition and aspiration. Let's get started and we'll see what you think about it all. Okay, here we go. So what the changes mean for you. So there's a few little changes that are being introduced for individuals and families. That is not our focus today. We've got a $1,000 instant work deduction, which will start from next financial year, and a small tax offset coming in a couple of years. Businesses have got the $20,000 instant asset write-off now permanently legislated. A couple of other changes there for business. Our focus today, though, is on negative gearing and CGT changes, as well as the changes to discretionary trusts or family trusts. As Heather mentioned, please post any questions that you have through this webinar in the Q&A section, and we will get to those at the end. We also have a number of questions that you have submitted prior to this that we will also answer for you today. Okay, negative gearing. In its simplest form, negative gearing is where your rental expenses are greater than your rental income and you make a loss, and you can currently offset that loss against your salary income. It's how many Australians have created wealth in their family groups across their lifetime, and that tax saving from the deduction of that rental loss has helped people get ahead essentially. So what the government is proposing, that from 1 July 2027, any properties that were acquired before budget night can keep negatively gearing their rental losses, but any properties bought after budget night essentially have to, they'll get a little bit of a transition. If you buy a property between 12 May and 30 June 27, you can negatively gear for that 12 or 13 month period, but after 1 July 27, that is where the changes to negative gearing come into play. Let me show you. Okay, so currently, losses from rental properties can be offset against other income. That applies to current properties or new properties. And there's no restriction on what you can currently negatively gear. You could previously, negatively gear property or shares or any other asset that produces income. So we have the grandfathering of pre-existing properties. You can continue to negatively gear those properties. But from 1 July 27, any properties that are purchased after budget night basically can not deduct those losses from their salary and wages income. The future rental losses, they're not lost, they can be carried forward, and you've got two uses for them. You can use them in the current year against existing rental profits. So if you've got a positively geared property and a negatively geared property, you can offset the negative gearing against your positive gearing. You can also use these losses to offset any capital gains on properties that you sell. So whilst you can't use them immediately, you can use them against other property income or down the track against a capital gain. So this only applies to residential properties that are not brand new and that have not added to the property supply. It doesn't apply to commercial properties or to shares. You can continue still to negatively gear commercial properties and shares. So they have got a little bit of a carve out for what they call new builds. So new builds can continue to negatively gear and you can offset those rental losses against your salary income. The new build investor can also choose to continue to access the 50% CGT discount. Or they could choose to index and pay the minimum 30% tax on sale. So there is a big tax advantage now in these new builds. So what is a new build? A new build includes apartments, it includes duplexes, it includes residential property that you build on vacant land. What it does not include are granny flats. It does not include properties where you just do a knockdown and rebuild on the one site, because you're not adding to the housing supply when you do that. So they're quite specific on the carve-outs, and you may speculate that these new builds are now going to go up in value because there are more investors that are going to want a new build as opposed to an existing residential property. Okay, so we've got two investors, a little example for you here of how the new rules work. So one has a grandfathered property that it owned before budget night, and then one purchases a property after budget night. So the one that purchased the property before budget night can still continue to negatively gear, and it gets its CGT discount up until 30 June 27, and after that some indexation. So there's a little bit of extra tax for the existing investor, potentially not too detrimental, the tax changes for the existing investor. For the new investor, however, it's a bit of an interesting situation. So let's say you had a rental property that you bought after budget night, and it made rental losses for the first 5 years. So you've then carried forward those losses because you don't have any other rental properties, and they're sitting in your tax return as a nice carry forward loss. You can, let's say the property then after years 6 to 10, it becomes positively geared. You can then use those rental losses, this 22,000, you can offset that against your rental properties for the next few years. And if you have not used all of those rental losses, you can then deduct them against the capital gain when you sell that property. So the rental losses are quite useful. And in this little very simple situation, there's not a lot of extra tax. So it's hurting you now because you're not getting the tax break. And many investors use that tax refund to help pay for their mortgage repayments on the properties. Those sorts of particular investors will be detrimentally impacted by this. But they essentially, the losses can be used down the track against other property income, against positive gearing, or against capital gains on residential property. Okay, let's have a little look at CGT. So from 1 July 2027, that is our key date for CGT change. The 50% discount is being replaced by indexation. Now, we had indexation between 1985 and 1999 when indexation was replaced by the 50% CGT discount. We're now going back to those days, But not only do we have indexation, we also have a minimum 30% tax on any capital gain that is made after 30 June 2027. So this blows a hole in the strategy that we have utilised for many years, that we would hold our properties in our working life and utilise that negative gearing to save us some tax. And then once we were in retirement phase and our income drops down, perhaps we're receiving tax-free pension, that has been the strategy to sell our properties then and to pay less capital gains tax because we are on a lower marginal rate. So this strategy absolutely shoots a hole in that, because we will be forced to pay a minimum 30% tax on those capital gains after 30 June 2027. So quick refresh of the current rules. If you hold the asset for more than 12 months, you get the 50% discount. That taxable gain was taxed at your marginal rate, which effectively was a maximum of 23.5%. Prior to CGT, we had no tax on these assets at all, and super funds currently enjoy a 1/3 discount, and they pay 10% tax on their capital gains. It's one of the very attractive things about making capital gains in super funds. So from 1 July 2027, indexation replaces that 50% discount, and we have to pay 30% minimum tax on our gains. Our pre-CGT assets lose that tax-free exemption. So this is something that has never been heard of before. We have never had a proposal to tax our pre-CGT assets. We now have the proposal that they will be taxed from 1 July 27. So what essentially happens for these assets that you owned before 1 July 27 is we will need to get a valuation done as at 30 June 27. Listed shares are easy, but for properties or even businesses that this may apply to, we will need a valuation as at 30 June 27. Let's say you're the person that had a pre-CGT asset and you were going to sell it after 1 July 27. So we would get a valuation as at 30 June 27. All the gain that you made before that date would still be tax-free, but any increase in the value after that date is now subject to the indexation, the 30% minimum tax. Big change for pre-CGT assets. These changes apply to individuals, trusts, and also to partnerships. So there are some exemptions that are being retained. The main residence continues to be free of CGT. There are 4 small business CGT concessions that are currently unchanged. Now, you can use these small business CGT concessions so long as you can satisfy one of 2 tests. One test is if your turnover is less than $2 million. And the other test is if your net assets, not just your business assets, are less than $6 million. Now, these thresholds were actually set in 2007. The government has not indexed the 2 mil or the 6 mil threshold since 2007. That's nearly 20 years ago now. So even the ATO has a $10 million threshold for small businesses, but these small business concessions are still capped at the 2007 levels. Seems a little bit unfair, you might say. There's an extra CGT discount for qualifying affordable housing that's preserved. New builds, as I discussed, that is preserved. And the only other carve out from these changes is if you are a pensioner or on job seeker, you are still subject to the indexation, but you don't have to pay the 30% minimum tax. That's essentially the CGT changes. Okay, let me run through 4 scenarios for you here. Okay, so if you had some shares that you bought before this date of change and bought for $100, you're going to sell them for $125 sometime down the track. Small return, let's say inflation's 2.5%. So your index cost base under the new rules is now $113 because you've got the uplift for inflation from your original cost. You've got a taxable capital gain now of $12. Now, if the CGT discount applied to you, then you would have had a gain of $13 because you wouldn't have had the uplift for inflation. So slightly less tax in this very simple situation. What I'm trying to show you here is that sometimes the indexation is on your side. If you had, let's say, a property. So this is a property that you owned before budget night and you paid $800,000 for it back in 2022. If you sell it in 2032 for 1.6 mil, we need to get the value as at 30 June 27. Let's say the value for this property was 1.1. So you've got some of your discount, some of your capital gain subject to discount. So we've got a taxable gain from the pre-30 June 27 value of 165. We've got the taxable gain from the post 30 June 27 value of 319. So you've got a total taxable gain now of 485,000. That is going to put you on the top marginal rate of tax, and you will pay $228,000 on the sale of that property. And if we had retained the 50% CGT discount, you would have paid tax of $188,000. So a transitional asset, even with the indexation and utilising the 50% discount, has paid $40,000 more in tax under the new rules than what they would have paid in the past. Let's say, another example for you here. You've got an asset that you paid $500,000 for. So if your return on that asset, if the increase in value on that asset is only 2.5%, then you actually save tax. If your return on that asset was 5%, which you might say is typical for a property over a period, then you will pay about $8,000 more in tax under the new regime. And if you have a higher return on your property, let's say 7.5%, then you'll pay about $60,000 more tax on your capital gain. Heath, do you want to go through the 30% minimum tax?
Yep. So the way the minimum 30% tax on the capital gain works. So Jack has a small income of $25,000 a year, and he realises an asset and makes a capital gain of $10,000. He doesn't receive any government assistance. So the tax on the $10,000 gain at his marginal tax rate, which is 21%, he would have paid $1,400 in tax. Under the 30% minimum tax requirement, he's now got to pay $3,000 in tax. So an additional $1,600 in tax under the new regime versus the old 50% discounting. So you can see for someone even on a very small wage or have other income, it's still going to cost them some money potentially.
So it's bad enough that we don't have the 50% discount, and now we have indexation, but this 30% minimum tax on the gains, this is really going to hit people. Okay, let's move into trusts. And I know we are moving through these quite quickly. We do have a lot of pre-asked questions, and we know that you guys have got questions too. So having a look at trusts. Now, the way that discretionary trusts are used for a number of reasons. They are used for asset protection. Lots of family groups like to own their assets in a trust because they are protected from creditors. They often are helpful for other reasons as well. So assets in discretionary trusts are protected from creditors. We have in the past been able to split our profits from the trust across various family members, but they are also used to transfer intergenerational wealth. So if you've got a family group that has a large share portfolio, they might want that share portfolio to move through their kids, their grandkids, and family trusts are used to hold these assets because there's no sale of the assets, there's no change of ownership of the assets when somebody passes away. The government, though, is only focusing on the tax saving of these trusts. They are basically ignoring the fact that discretionary trusts are used for asset protection and intergenerational wealth transfer. So anyone, and I know within our client base, we have a lot of use of discretionary trusts. They are a vehicle which has enabled our client base to do many things within their family groups. And across the business community, they are widely used vehicles. So this impact of the taxation of the trusts, in my view, has far more detriment for us than the change in the negative gearing or the CGT. So how does the trust work? So basically, if you've got a trust and it makes some profit, let's say you're Peter over here and he's made $200,000 via his trust. If he can share that across 4 beneficiaries, then the total family tax is about $24,000 or 12%. But if you've got Piper, who's earned $200,000 as a salary, the tax that she pays is $59,000 or 30%. So Piper, as a salary earner, has paid an extra $35,000 in tax compared to Peter, who has earned his income through a trust. So this is why the Parliament, the government, is looking at trusts, because they are focusing on the inequity of the salary and wage earner versus the person that has utilised a trust structure. They believe it's unfair. Okay, so how it's going to work. So from 1 July 2028, so we have got 3 tax years before this comes into being. We've got 30 June 26, 27 and 28, and then this trust taxation comes in after that date. So the proposal is that the trustee itself will pay a 30% tax. So currently what happens with a trust, it makes its profit and the trust itself does not pay tax. It flows down to the beneficiaries and they are taxed at their marginal rate of tax. What this proposal says is that the trust itself will pay the tax on that income, and any tax credit can flow down to certain beneficiaries. So what's going to happen is the trust will pay a 30% minimum tax on the trust income. If you have a beneficiary that is an individual or a non-corporate, so a non-company, they will receive a non-refundable tax credit. What has happened in the past, if your trust has owned shares in a private company or publicly listed shares, and it has received some franking credits, those franking credits have passed down through the trust to the beneficiary, and the beneficiary has been able to get a tax refund for any excess franking credits. What the proposal is here is that the trust tax credit will not, any excess trust tax credit will not be refunded to the beneficiaries. So it's going to cause us to pay extra tax to beneficiaries on lower rates of tax. I've got some examples that I'll show you in a minute. So where a beneficiary pays greater than 30% tax, it's not going to be a detriment to them. But where the beneficiary pays a lower marginal rate or a lower average tax rate than 30%, there will be a detriment to those people. If you are running a business through a trust, many people have a strategy where they don't take a wage through the trust, but they just receive a trust distribution. If we put those people on a wage through the trust, then they are not impacted by this 30% tax. So that may be one strategy that we look at for businesses that trade through trusts in the future. We have some exclusions from this 30% minimum tax. If you have primary production income run through a trust, that is excluded. Vulnerable minor income is excluded. If you have non-resident withholding, that is excluded. If you have a discretionary testamentary trust that existed before budget night, that is excluded from the 30% tax. So trusts that are not affected are unit trusts or publicly listed trusts, which are also called widely held. Complying super funds are excluded. Thank goodness the government has left super funds alone in this budget. It has done enough fiddling around with them, as we know. Special disability trusts are excluded. Deceased estates, so that is the estate. So after you pass away, you then have an estate tax return that you basically have 3 years to lodge. You're still utilising marginal rates of tax. Those estates are currently excluded from this 30% tax rates, as are charitable trusts. There is a problem for bucket companies. So anybody that has a bucket company in their structure now has a significant tax disadvantage. The bucket companies are not eligible for the flow-through tax that the trust has paid. Trust pays 30% tax on income. If that income goes to a bucket company, the bucket company does not get the credit of that 30% tax paid. They pay an additional 30% tax on the income that goes to them. So the bucket companies will now essentially pay, let's call it 60% tax. So any structure with a bucket company needs to be closely looked at and possibly restructured. Okay, let's have a look at some actual examples. So, Heath, do you want to actually talk through these?
Okay, so Peter is a salary and wage earner who earns $80,000 a year. his tax that's on his salary is about $16,000 for the year, with an average rate of about 19.5%. And as an employee, these new 30% tax isn't applicable to him. But Pam, who operates a business through a trust or has and earns $200,000 in that trust for the year, can split that income and distribute to 4 of her family members at $50,000 each, means the total family tax on the $200,000 is about $24,000 or 12%. So they're saving about $35,000 compared to if they weren't operating through a trust. But Penny, who receives the same $200,000 as a salary, she pays $59,000 in tax, an average rate of $30,000. So you can see there that Penny pays about $35,000 more in tax than Pam does, being able to split the profit from the trust with her family members. So this is where, when Pam's trust now has to pay the 30% on the tax, it's about $60,000 that has to be paid, and the flow down effect through to the family members will bring their average tax rate up to 30%, which is the same as Penny receiving the $200,000 as a salary.
So you can see by this example that there is a definite tax benefit splitting your income through a trust to family members as opposed to being an income worker, a salary and wages earner. And again, this is why the Parliament is looking at these trust changes. We've got a little example for you here. If you run a business through a trust or run a business through a company under the new rules, what's the impact for you? So Tim is running his business through a trust. He's earning $200K of income. Tammy is running her business through a company on the same $200K income. So with the 30% new tax, Tim's trust will pay $60,000 on his trust profit. Tammy's company only pays tax at 25%, but she will only pay $50,000. So essentially, the tax paid through the trust, by the time there's additional tax paid on the distribution out, the trust income is essentially taxed at $86,000 versus the company income being taxed at $72,000. But I think, Ev, you've got a point on this, haven't you?
Yeah, you do need to watch though. When you've got a company and the company pays the tax, that's at a flat 25 or 30% tax rate. Then when a dividend is paid out of that company to the shareholders then may have to pay additional top-up tax of about 23, 24%, depending on their marginal tax rate. So you've got to take that into account.
That's it. So be wary when you're looking at restructuring. You can't just look at the company rate of tax. You need to look at any top-up tax that is paid when dividends are paid out of company profits. Okay, we've got an example for you here. So we've got a family trust, a discretionary trust that earns a dividend, that receives a dividend of $750,000. And it also receives some franking credits of $250,000. It's now got trust income of $1 million that it wants to split across its family group. So what this situation shows you is where you've got somebody on an income of above $200,000, they can utilize the full of the 30% trust credit. But where you've got incomes under $200,000, you start to lose some of those trust credits. So in this situation, we've got mum that has received a taxable distribution of $333,000. This person will receive all of the tax credits and still have some tax payable. So no tax credits are lost in this situation. Let's say you've got dad that's on $266,000, still has to pay some top-up tax, no tax credits are lost. Then you come down to the kids. Now, let's say you have the ability to distribute this much to the kids, but at the first child, they've only got tax to pay of $59,000. They've got a tax credit of $60,000. They don't get a refund of the excess. We lose $130 in tax. But you can see how 200K income is about the income level that beneficiaries need to utilise that trust tax. Second child has got taxable income of 133. They will not be refunded this excess tax of 6,800. Child 3 only has tax to pay of 11. They get a credit of 20. They will lose this $8,000 in excess tax. So across the family group, we have lost $15,000 of tax that we would previously have been refunded. Let me show you an example of where you have business income that has flown down through a trust that doesn't have any franking credits or tax credits. So this business income, we're going to split it in the same proportions across the family group. And where we end up is because we don't have those franking credits, we've got mum paying some extra top-up tax, but everybody else losing these excess trust credits. So we are $22,000 worse off by distributing our $750,000 across the family group than what we would have been previously. If all your beneficiaries are on a high marginal rate or greater than 30% average rate of tax, there's no problem. If they're not, that's when we start to lose these trust tax credits. Okay, so there is rollover relief available if you want to restructure out of your discretionary trust. If you move into a company or a fixed trust, you get these CGT exemptions for this 3-year period. We essentially have, so this trust tax comes in on 30 June 27, and you have until 30 June 2030 to restructure and not pay any CGT. The big red flag, though, is any time you move assets out of that trust that are subject to stamp duty, like property, you will have to pay stamp duty on that asset transfer. If you are moving shares, shares are no longer subject to stamp duty, so there's no stamp duty detriment to moving shares out of a discretionary trust. From 1 July 28, if your assets stay in the trust or you continue to trade your business through a trust, you will pay the 30% minimum tax. If you pay a genuine wage out to family members, that's not subject to the 30% tax. And this structure continues to work so long as you have beneficiaries on 200K income and above. It may appear to pay more tax than the company, subject to top-up tax on the dividends. If you restructure to a company, then you've got access to a 25% small business tax rate if you are a trading business. If you move investment assets to a company, the company's rate of tax is 30%, not 25%. The difference in the company is that anybody that receives a dividend that company pays, if there are excess franking credits, they will get refunded to the recipient of the dividend, as opposed to the trust tax credits, which don't get refunded. So a big difference in the usage of the tax that has been paid. We talked about the rollover relief. We've mentioned the stamp duty. So you can also restructure to a fixed trust. A fixed trust is a unit trust, and a discretionary trust, you have the choice every year as to who to put the income to. A fixed trust, it is a fixed entitlement to those unit holders every year. So if you want to move from a discretionary trust up to a fixed trust, that can be done and the rollover relief can be utilised. And then you have got the flow through of any of those franking credits that you might have earned down to the family members. So we have got less flexibility than a discretionary trust. We know that stamp duty is still potentially an issue on any property movements, but the unit trust does give the flow through of those franking credits. There is a lot of planning that's going to be done if these trust measures are passed. And we need the weight of conversations in the community. We need lobbying to members. We need the government to be listening to people and the impact of this trust change. But if these measures passed as they are very much detrimental to current discretionary trust users. Okay, there's a few key dates. All our slides will be emailed out to all of our attendees. at the end of our presentation, and we will also have a recording of this session if you want to go back and flick through to any of the sections. So key dates are there. I'll let you read those at your leisure. And yeah, so essentially what should we do now? We need to be thinking about the grandfathering. We need to see how that change to negative gearing impacts our particular properties. We need to think about how the CGT change impacts our particular situation. And we need to be mindful that we'll need valuations as at 30 June 2027 for our properties or our businesses if they are sold after that date. There's going to be some modelling that needs doing for every single investor and every single business owner under the old rules and the new rules as to how it's going to impact you and what, if anything, we can do currently to mitigate any difference in tax. The trusts is the biggie. The reviewing the trust structures, reviewing the assets that are held in the trusts. That definitely needs doing. We need to consider paying the genuine wages to the family members, and we need to be thinking about the rollover relief, accessing that rollover relief, and also considering the stamp duty implications of that. So, you know, there's many years where we hear the budget and there's not too many changes that happen, but this is a year where we all have to sit up and take notice because the changes are very far-reaching, both for us as current investors and business owners, but also for our children and their future investment decisions. So we need to be across these changes once we actually find out what the exact changes are going to be. Reminder, the CGT negative gearing is being introduced into Parliament tomorrow. They are trying to rush through the changes without any too much extra consultation. The trust changes, there is a little bit more time. Okay, let's move into our questions section, and I will hand over to Heather to run through your live questions, and then we'll go back to the pre-asked questions.
Okay, so 2 questions, Jen, for you from our Q&A. From Debbie, a lot of property investors, builders set up new trusts and companies for each project, protecting themselves and leaving the purchaser to carry the loss if they go belly up. If this arrangement is no longer beneficial tax-wise, do you think that it will impact their ability to borrow, resulting in less developers bidding against individual purchasers at auctions?
Yeah, and that's a great question. Thanks, Debbie. I would suggest that developers would no longer use trusts to do their developments. They would use companies. So they would quarantine their asset protection, their litigation risk within a company so that they don't have to pay that minimum 30% tax in the trust. That would be the solution for property developers. The banks tend to favour a company over a trust for a lending arrangement anyway. So I certainly don't see any lending issues if they are running their property developments through a company. But I certainly think it would not. They would not continue to use trusts. It's just too tax detrimental.
Second question from Jono. Labor is apparently looking to rush the CGT and negative gearing changes through Parliament ASAP, and then will then tackle the trust changes in the future. There's been a bit of noise in the press, especially in the last few days, of more objections being discussed, even on the CGT changes. Given your knowledge and experience, do you believe that the CGT changes may be stopped and not put into law, or is it more likely this is going to happen?
Yeah, I'll just grab the crystal ball out, Jono. Certainly the government is trying to rush the changes through, and what they have come out and said is that if there is going to be any carve out, now they do propose or purport that they were talking to the tech sector before the budget announcements about potential carve outs for the tech sector. There has been a lot in the press about this sector because we know what happens in this sector is they start these businesses with no value. There's not a lot of big asset investment, and they tend to pay their employees lower amounts, and then they issue employee shares to these employees. They also often bring investors in to invest in these businesses so they can continue to grow them. And the CGT change is very detrimental to these people because most likely, particularly larger investments coming in would not be eligible for the small business concessions, and they would just pay 47% tax on any gain they make on the shares that are sold in these startup tech companies. So any carve out the government is proposing will be passed as a separate bill. So they will rush through the changes as they are, the negative gearing and the CGT, with very little consult. but the consult will happen for any carve-outs, and that will be a separate piece of legislation that happens in the future. I would like to think that they would carve out small businesses from the CGT discount changes, as well as, so not just tech businesses, but all small businesses, maybe even businesses altogether, to be honest. That would be more than appropriate. It would be really kind if they limited the CGT discount change to residential property. Remember that the government, their whole focus, so they say, on the changes to this CGT and negative gearing is to create more housing for our young Australians. And I'm not sure how they can argue that taxing, removing the CGT discount for businesses and removing the CGT discount for shares, I'm not sure how they can argue that that actually adds to the housing supply. So we may see more carve-outs. I hope we see more carve-outs. Can't say, to be honest. Yeah.
Okay. What age does a child become an adult for family trust distributions? Matt has asked.
Thanks. Good question, Matt. So two different trusts. So if you have a discretionary trust, a child gets the tax-free threshold from the day they are born. There was no minimum age for the tax-free threshold coming through a distribution from a testamentary trust. If you have a family trust, the child needs to be 18 before they can receive a trust distribution, anything above $416.
There are other rules around Section 100A of the tax legislation, which can also prohibit how much you can distribute to an adult child.
Yeah, and that's a really interesting point, Heath, because so 100A has been in the legislation forever, but of the last 3 or 4 years, the ATO has really started to focus on 100A. So in the past, we might use particularly kids between the 18 and 25 age brackets that might have been at uni or earning a lower income, and we might have streamed some of the family business income into their returns or some of the investment income into their returns. And what 100A does is it caps the amount that we can distribute to those adult children at the physical amount that the parent has paid on their behalf. So if you're a parent and you've bought a car for your child, or you've paid a help debt, a university fee for your child, or you've given the child an allowance of $200 a week, then those amounts can be captured and then distributed to the child and included in their tax return. So 100A has already restricted the amount that we can distribute to adult children, but this 30% tax, it clearly restricts it even more and almost makes it not tax effective to distribute to those adult low income children. Yeah.
Thanks, Jen. Okay, so now on to some questions that we have been asked by clients recently.
Okay, so there's a few of these guys, so we'll get through them. Okay, I'll do the first one, Heath. Are the negative gearing changes that bad? So in my view, the negative gearing changes are the least detrimental of the 3 main changes, because you don't lose your losses. You can carry forward those losses. You can offset them against other rental property income, and you can also offset them against property capital gains. So the situation is not as good as we have it now, but the losses still can be utilised down the track. So not as bad as some of the other changes. Okay, Heath.
Okay, so you own your own home before 30 June 27. Can I now rent it out and negatively gear it? Yes, you can.
Oh, sorry, Heath, you go.
Yep, not a problem at all. Might have some other tax issues, but yes, you can claim those negatively geared losses against other income.
And the reason you can do that is because you owned that property before budget night. So there's a lot of you will be familiar with the 6-year exemption of renting out your main residence when you don't have another main residence, and the ATO has not touched that exemption either. So if you were the person that was going to go and work in London for 2 years and you owned your home before budget night and you decided to rent it out, you could continue to negatively gear it, and you could also rent it out for 6 years without triggering CGT. So that 6-year exemption has not been mentioned in these CGT changes. Heath.
Okay, what about, Jen, if I build a granny flat on my property, can I negatively gear that?
So the government says no, granny flats are not included in the definition of new builds. New builds includes new apartments, houses built on land that didn't have a house already, and duplexes. So essentially you need to be adding to the housing supply to be able to utilize a new build and utilize the negative gearing on a new build. Don't forget those new builds continue to get that 50% CGT discount as well. So very attractive from a tax perspective.
Okay, so Jen, talk us through how the removal of the 50% CGT discounts apply when I sell my business.
Yeah, so there's two ways to sell a business. You can sell the assets out of the business, or you can sell the shares in the company that owns the business. If you sell the assets out of the business, the 50% discount never applied to those sales. Those sales are always taxed at the company marginal rate of tax. And then if you take that money then out of the company, you potentially pay top-up tax on any dividends that come out. If you are selling the shares in your company, and this often happens when we have a larger organization buying a smaller company. They want to buy the shares and then swallow that company up into their group. So we have been using this 50% CGT discount when the shares in a company are sold. If you are able to utilize the small business CGT concessions, so if your business has a turnover of less than $2 million, or if your assets, excluding your super and excluding your family home, if your assets are worth, including your business value, are worth less than a net of $6 million, you can access the potentially there's four small business CGT concessions. Sorry, got tongue-tied. So you can continue to access those small business concessions if you sell after 30 June 27, but you can't access the 50% CGT discount. So if you can't access the concessions, you'll be taxed on your business sale at 47%. And that's why there is so many social media posts about Albo being a 47% shareholder in businesses. So you're okay if you can access the small business concessions, but if you can't, then the tax on your business sale is up to 47%.
Okay, so then how does the 50% CGT discount removal apply when I sell my, say, BHP shares or other listed shares?
Yeah, that's right. So many people own shares for many different reasons, and we have been using the CGT discount when the shares are sold. Obviously, the sale of these sorts of shares has got nothing to do with the small business CGT discounts. So any share sale after 30 June 27 will be subject to indexation, the minimum 30% tax. So if you've owned BHP and you paid $10 for them, and as at 30 June 27, they were worth $60, the capital gain between your $10 and your $60 is subject to 50% discount. But if you sell your shares after that date and they're now worth $80, then you don't get that discount. You get a bit of indexation, but you have to pay a 30% minimum tax on the sale of those shares. And if you are selling those shares when you are in the retirement phase of your life and your taxable income is a lot lower, then potentially that 30% tax is going to cause you to pay more tax on the sale of those shares than you would under the current 50% discount regime.
Okay, so I've held some property outside of super for about 30 years. Should I now consider moving them into my self-managed super fund?
Yeah, and this is a really good question. One of our beautiful clients posed to us. So residential property can never be transferred into a self-managed super fund. Commercial property can be transferred into a self-managed super fund, and that applies to commercial property that you own and use in your current business, or commercial property that you rent to somebody that you don't know, an arm's length tenant. So if you do own commercial property outside of super, you can move that into your self-managed super fund. You are subject to the contribution caps though. So The contribution caps are currently $30,000 for a deductible contribution and $120,000 for a non-concessional or non-deductible contribution. So your property would have to be worth less. You could utilize the 3-year bring forward rule for 2 of you. So basically there's $720,000 worth of value that could go into the super fund. But if your property is worth more than that, then you're not going to be able to get a commercial property into super. You could, though, if you didn't want to transfer it as an in specie contribution, you could sell that property to your super fund. You're crystallising the capital gain currently. In both situations, you're crystallising the capital gain currently. Your super fund could then borrow to buy that property, subject to the stage of life that you're in, and if you choose to do that. And then the future gains would then be subject to the super fund rates of tax, which is 15% on income and 10% on gains in accumulation, and then 0 once you are in that retirement phase, subject to what your member balance is. If you do want to look at this strategy, that is something that you definitely need to talk to us or to your particular advisors about. There are some benefits, but there's a whole lot of rules that we're going to need to abide by to make this structure work. So the main points out of this: residential properties cannot be transferred into self-managed super funds. Any property that you move is going to attract CGT and stamp duty, so you've got to think about that when you're moving properties. Commercial properties and also shares can move into self-managed super funds, either as in specie transfers, in specie contributions, or as direct sales. Anyone that wants to continue to ask questions about these questions, I'm happy that you continue to post them in the chat. Otherwise, we'll just keep going through our pre-submitted questions. Okay, Hev.
So if I own my business before 30 June 27, and will I need to get it valued at 30 June 27?
I would suggest yes. So if we want to utilise that period that we owned the business before 30 June 27 and use that 50% discount, we will very much need a valuation as at 30 June 27. After that date, we'll get some indexation. We'll also have the minimum 30% tax on that gain, up to 47% if we can't utilise those small business concessions. So valuations absolutely are going to be needed for businesses, for shares, and for properties.
Yeah. So in terms of businesses, we would be valuing the shares that you own, which forms part of how much is your business worth.
Yeah. We've just had a question pop up from Debbie. The issue with the 6 mil asset test and the 2 mil turnover test being the small business definition, do we think that's too low? Absolutely it is, particularly when it's contradictory to the ATO small business definition, which is 10 mil. And the fact that these amounts haven't been indexed in nearly 20 years, absolutely these numbers are too low. But the government is incredibly silent on changing those thresholds. We would very much appreciate them increasing those thresholds, that is for sure. Okay, Hev.
So what happens to my pre-CGT owned assets? So these are our assets that we owned before September 1985.
So any gain that you make on those assets is tax-free up until 30 June 27. And after that date, the gain is subject to indexation and the 30% minimum tax. So if you've got a property that you bought before September 1985, you will get a property valuation done as at 30 June 27, so that you know how much of the potential sale price is tax-free versus how much is going to be subject to indexation and the 30% minimum tax. We have some clients that have pre-CGT assets in companies. Again, just note that the CGT discount and this CGT change does not apply to companies. They were never eligible for the CGT discount in the first place.
Okay, do I have to pay for my valuation for my properties at 30 June 27?
Potentially. So what you probably won't be able to use is a real estate's valuation for a property. So with our self-managed super funds that need to get valuations, which essentially we get each 12 months, they are able to use a real estate agent to provide that valuation. But for these purposes, you will need to pay for a valuation, or you can use the ATO tool that they propose that they will introduce. If you want to encourage your kids to go into a career, maybe encourage them to be a property valuer. There might be an explosion in in the workload for the property valuers. Okay, moving on to some questions from trusts. Heath.
Okay, so will the rollover relief apply if you move assets from a trust to an individual?
We don't believe it will, unfortunately. So there has been no commentary on this anywhere. But the rollover relief at the minute is proposed for the movement of assets from trusts either to companies or to unit trusts. And just remembering that the movement of any asset from a trust to an individual will trigger CGT on the movement of that asset.
Next question we received was, will the 30% trust tax apply to testamentary trusts already included in wills at 12 May 26, being budget night, when the person had not passed away at that date?
Yeah, and isn't that a good question? So you've done your estate planning, and you've included your discretionary testamentary trust in your will because you want your assets to go into a testamentary trust to then be utilised for future generations. If your testamentary trust is discretionary because you've not passed away, then it will be caught by the 30% trust tax rules. A testamentary trust doesn't come into operation until after probate has been passed. So you would need to have died and passed through your probate for your testamentary trust to come into place, into being. And if that is after budget night and that trust is discretionary, then it will be subject to the 30% trust tax. So discretionary trusts, like family trusts, are a widely used vehicle for asset protection and intergenerational wealth transfer. So, excuse me for a minute. So you may, if you have one of these discretionary testamentary trusts in your will, you may consider updating your will to, I'm going to cough, Hev, to either remove that trust out of your will or to make it a fixed testamentary trust.
So now could be a good time for you to look at your whole estate planning situation and determine, is, in addition to looking at your trusts and other assets, what should I be doing for my estate planning purpose? Should I be updating my will with consultation with lawyers and also your other accounting advisors to know whether your whole estate planning is working the way it should?
Absolutely. Okay. So which trusts are exempt from the 30% tax?
Deceased estates, fixed unit trusts, existing testamentary trusts, fixed testamentary trusts, complying super funds, so your self-managed super funds, special disability trusts, and charity trusts.
So we have some exemptions, but they certainly don't include our widely used discretionary trusts. Okay, sorry, you go ahead.
Trusts that will be taxed at 30% from 1 July 2028 are your discretionary family trusts and discretionary testamentary trusts that are not already in operation. Okay, if a trust is taxed at 30%, do the beneficiaries get the refund like franking credits currently? Jen?
So the beneficiaries get the tax credit to reduce their tax to nil, but any excess of that tax credit is not refunded. It stays with the taxman. So it's essentially lost. So the flow through impact of the tax that trusts received in the past is still there, but it's limited to the amount of tax that you have to pay. No refund of the excess. We know that complying super funds, self-managed super funds, when they have an excess of franking credits, they get those franking credits refunded. So the flow through of credits still applies to super funds, but any excess of those credits in trust is not refunded, whereas it is still refunded in super funds.
Okay, what about bucket companies, Jen? When a trust distributes down to a company some of their profits during the year?
Yeah, so bucket companies have been used by family groups in the past when they wanted to cap the tax rate on distributions to trust beneficiaries. So if you had $1 million distribution from a trust and you had the beneficiaries already on high income levels, let's say the 40%, 47% rate of tax, you might distribute that money into a bucket company. Now, the cash has got to flow as well, but that bucket company may then go and do its own investments and utilize that money at the company rate of tax, a 30% rate of tax, rather than the individual's 47% rate of tax. So what the government has done by these changes is they have said that any of those trust credits, they do not flow down to these bucket companies, but these bucket companies have to then pay tax on that income as well. So essentially they are very heavily penalised now with tax, and you might suggest that there's not going to be many circumstances that would exist where we would continue to use a bucket company. So they very much have put some holes into the bucket and leaked all the benefits out. That is for sure. Okay. Let's see. Okay. All right. I think that clears all our questions that we have been sent, and also clears the questions that you guys have asked during the session today. Essentially what everybody needs to be thinking about now is, what do you need to do? How do these changes impact my personal situation? Whatever plans you might have had in the past, you might need to relook at those plans. How should I be holding my assets so that they are still protected, but is there a way that we can still make that tax effective? You need to look at assets held in your own name. You need to look at assets held in trusts, assets held in companies, assets held in super funds. You need to consider your estate planning and what impact the trust taxation has on that. You need to think about how the transitional rules apply to you, what valuations you might need for those assets. Think about the stamp duty implications of moving any of those assets. All of these trust changes will have a big impact on us personally. We are happy to talk through these changes as they apply to you. Certainly, there's going to be a great deal of restructuring that happens as these changes become law and as we know the final detail of them. So think about your position, talk to us about it, talk to your advisors about it. But the key is, if you do nothing, then most likely you will have more tax to pay in the future than you have had in the past. So I would say thank you very much for joining us today. As we've discussed, the proposed federal budget changes are very wide-ranging. They have significant impacts across our investments, they impact our tax planning, and they're going to impact our business decisions over the coming years.
So while all these measures are still subject to legislation passing, now is the time to review your position, understand the potential implications, and consider what proactive steps may be appropriate for you and your family.
If you have any further questions on the impact of how these proposed changes impact you, please reach out to your Sullivan June client manager, reach out to Heather, reach out to myself. We're happy to help you walk through how it applies to you. Thank you everybody for joining us this morning. Enjoy the rest of your day. And remember that good investment decisions are rarely made in reaction to change. They're made through preparation for change. I'll leave that with you. Thank you for joining us.
Bye. Bye.